What if the most consequential moment in decentralized finance history is not a hack, a market crash, or a regulatory crackdown, but instead a quiet announcement on a Tuesday in July 2026 that sees the world's largest decentralized exchange quietly begin closing its doors to the public? Yesterday, on the 22nd of July, 2026, Uniswap confirmed it is pushing deeper into tokenized real-world assets by launching permission trading pools. That single decision has reignited one of the most divisive debates in all of crypto. Can decentralized finance remain truly decentralized when Wall Street money is allowed to walk in through a compliance-controlled entrance? As of today, the 23rd of July, 2026, the reaction is fierce on both sides. In this video, we break down exactly what happened, what it means in concrete terms, and what every DeFi participant needs to understand right now. To understand the significance of yesterday's announcement, you first need to grasp what a permissioned pool actually is, because it is a fundamental departure from everything Uniswap was built on. Standard Uniswap pools are open to every wallet on Earth, no questions asked. You connect your wallet, you swap tokens, you provide liquidity, and you earn fees without identifying yourself to anyone. A permissioned pool introduces access controls. Specific wallet addresses must be added to an approved whitelist before they can participate. Think of it as a private members club operating inside what was previously a completely public marketplace. The pools Uniswap is now launching are designed specifically to accommodate tokenized real-world assets, government bonds, money market fund shares, private credit instruments, and other traditional financial products that have been converted into on-chain tokens. These assets carry legal compliance requirements. Institutions cannot hold or trade them unless know your customer checks have been completed and regulatory sign-off is in place. The permissioned pool is the technical mechanism that enforces those requirements on-chain. This move did not arrive in isolation. It is the product of months of converging institutional pressure on decentralized finance. Back in June 2026, Standard Chartered issued a price target of $100 for Uniswap's governance token. That target was not based on retail trading volumes. It was built on the bank's conviction that tokenized real-world asset adoption on decentralized rails would generate substantial and sustained fee revenue for Uniswap. At the same time, JPMorgan has been running its Mony fund directly on the Ethereum network, demonstrating that one of the world's largest banks is not merely experimenting with blockchain but actively deploying live financial products on public infrastructure. Swift has been testing its Linea ledger as a cross-border settlement layer. The institutional race to bring traditional assets onto blockchain rails is no longer a future projection. It is happening right now, and Uniswap has moved to position itself as the trading layer where those assets will be bought and sold. To appreciate how large the prize is, you need to understand what tokenized assets represent as a market. A tokenized asset is a traditional financial instrument that has been converted into a digital token on a blockchain. A government bond becomes a smart contract. A share in a money market fund becomes a transferable token that settles in seconds rather than days. The appeal for institutions is enormous: faster settlement, programmable compliance rules embedded directly into the token, and the ability to trade around the clock without relying on clearing houses, custodians, or correspondent banks. By mid-2026, the tokenized asset market has grown to several $100 billion in notional value. Major banks, including BlackRock, JPMorgan, and Franklin Templeton, have all launched tokenized fund products on public blockchains. Projections from institutional research desks suggest this market could reach the multi-trillion-dollar range within the next few years. Uniswap's permissioned pools are not a minor feature update. They are the protocol's bid to become the primary trading venue for this emerging and potentially enormous asset class. The reaction across the decentralized finance community as of this morning, the 23rd of July, 2026, has been sharply and predictably divided. On one side, Uniswap advocates argue that this is the natural and necessary evolution of the protocol. Fee revenue from institutional tokenized asset trading could dwarf what retail swap activity has ever generated. The protocol needs to grow or risk becoming a rounding error in the broader financial system. On the other side, a vocal and substantial cohort of DeFi purists views permissioned pools as a direct betrayal of the principles that made Uniswap worth building in the first place. The phrase open DeFi problem has circulated widely this week, a concept highlighted by CryptoRank in their analysis of Standard Chartered's Uni price call. The core grievance is clear: if Uniswap must implement compliance gates to attract institutional capital, then the protocol is no longer decentralized finance by any meaningful definition. It becomes a regulated trading venue that runs on smart contracts, which is a very different thing. Let us examine the open DeFi problem more carefully, because it cuts to the heart of what public blockchain technology was designed to achieve. The original promise of DeFi was radical and simple: permissionless access. Anyone, anywhere, with any amount of capital could participate on equal terms. No banks, no brokers, no gatekeepers. Permissioned pools undermine that promise by creating a two-tier structure inside the same protocol. Institutions and accredited investors gain access to deep, institutional-grade liquidity and the most valuable tokenized assets, all within a compliant, whitelist environment. Retail users remain in the open pools but may find that the most liquid and highest yield opportunities now sit behind a compliance gate they are not permitted to pass through. Standard Chartered's own analysts acknowledged this tension directly in their June 2026 research note, describing it as the open DeFi problem that Wall Street may ultimately need to solve. The uncomfortable question is whether solving it means reshaping DeFi to serve institutions, or finding a way for institutions to participate without restructuring what makes DeFi open. Looking forward from today, the near-term trajectory for permissioned DeFi appears well established. Uniswap is unlikely to be the last major protocol to make this move. Aave has already launched institutional products under its Aave Arc framework. Compound has explored similar compliance-focused pools. The broader signals from traditional finance are unambiguous: JPMorgan's Mony fund on Ethereum, Swift's Linea ledger trials, and BlackRock's Tokenized money market fund are all live, not experimental. Regulators in the United Kingdom, the European Union, and the United States have each been building frameworks that permit tokenized securities trading under clearly defined compliance conditions. Uniswap's permissioned pools are a direct and deliberate response to that regulatory trajectory. If even a fraction of the multi-trillion-dollar projected tokenized asset market routes its trading through Uniswap, the fee revenue implications for the protocol would be transformational, and every competing DeFi protocol knows it. For anyone holding Uni tokens, yesterday's announcement carries concrete and immediate implications. Uniswap's fee mechanism, which can route a portion of trading fees to the protocol treasury and potentially to token stackers, becomes dramatically more valuable if institutional permissioned pool volumes become significant. This is the precise logic behind Standard Chartered's $100 price target for Uni. The bank's thesis is straightforward: higher institutional trading volumes translate to higher protocol fee revenue, and if that revenue is distributed to Uni stackers through the fee switch, the token transforms from a pure governance instrument into a yield-bearing asset with a credible earnings basis. That transformation, if it materializes, would represent a fundamental change in the Uni investment case. Whether that shift is positive or negative for decentralization is a philosophical debate. For investors focused on protocol fundamentals, the fee revenue argument is the most concrete and specific bull case for Uni that has existed since the protocol first launched. So where does all of this leave us on the 23rd of July, 2026? Uniswap's move into permissioned tokenized asset pools is not a minor protocol update. It is a structural pivot that reflects the direction the entire crypto industry is moving, toward institutional adoption, regulated compliance rails, and deep integration with real-world financial assets. The open DeFi purists are correct that something meaningful is being traded away. A protocol that once treated every wallet on Earth as an equal participant is now building rooms that most of the world cannot enter. The institutional pragmatists are equally correct that without this evolution, DeFi protocols risk becoming niche technology rather than foundational global financial infrastructure. The most plausible outcome is a dual-track future: permissioned institutional pools running in parallel with open retail pools, both generating fee revenue for the same protocol. Whether those two tracks stay genuinely connected, or gradually drift into two entirely different products sharing a brand name, will define what decentralized finance actually means for the decade ahead. Stay subscribed, because this story is only just beginning.